The ATM screen flickers. You press withdrawal. The machine hums longer than usual, then nothing. You press again. A message appears. Temporary service interruption. Please try another location. You walk 3 blocks. Same message. By the time you reach the 4th machine, there's already a line. No one's talking. Everyone's checking their phones. That's when you notice the notification. Your bank's app won't load. This is day 7. Let's rewind. In this simulation, the Federal Reserve announces an emergency monetary intervention unlike anything in modern history. $10 trillion printed, injected, deployed across the financial system in a single coordinated action. The stated reason doesn't matter here. What matters is the mechanism. What matters is what happens when the largest economy on Earth attempts to create value from nothing at a scale that dwarfs every quantitative easing program combined. What matters is the timeline. We assume the announcement happens on a Monday. Markets are open. The statement is carefully worded. The Fed chair emphasizes temporary measures, liquidity support, economic stability. The press release is 14 paragraphs long. Most people will never read past the headline. Within 90 seconds, algorithmic trading systems begin responding, not to the policy itself, but to the detection of the policy in text form. High-frequency traders don't interpret. They react. U.S. Treasury yields spike, then plunge, then spike again as conflicting algorithms clash in microsecond intervals. The Nasdaq halts trading twice in the first hour, not because of a crash, because of velocity. By market close, the Dow is up 4%. Financial media calls it a relief rally. Analysts appear on camera explaining why this was necessary, why it's different this time, why the Fed has tools previous generations didn't. Retail investors, burned by years of inflation, see green numbers and feel a flicker of hope. Some buy back in. That night in Hong Kong and Singapore, a different conversation begins. Currency traders don't wait for confirmation. They front-run inevitability. The US dollar index begins to soften in after-hours trading. It's subtle at first, 0.5%, then 1%. By the time New York wakes up on day 2, the dollar has fallen 3% against a basket of major currencies. This is not subtle. For the world's reserve currency, this is a tremor. The euro surges. The yen strengthens despite Japan's own monetary experiments. The Swiss franc, that ancient safe haven, begins moving in ways it hasn't since the 2008 financial crisis. But it's not flowing into those currencies because they're strong. It's flowing out of the dollar because 10 trillion is a number that breaks perception. On day 3, the first cracks appear in the credit markets. Corporate debt, particularly investment-grade bonds, begins repricing. Not because companies are failing, because the dollar those bonds are denominated in is losing coherence. A bond promising to pay you $100 in 10 years is worth less if those future dollars purchase half of what they do today. Bond traders know this. They begin selling. Bond prices fall, yields rise. The cost of borrowing for American corporations increases even as the Fed insists it's providing liquidity. This creates a paradox. Companies that need to roll over debt to refinance maturing obligations suddenly face higher interest rates in an environment where the central bank is theoretically easing. The mechanism is simple. The market no longer trusts the denomination. By day 5, inflation expectations embedded in Treasury inflation-protected securities spike to levels not seen in 40 years. This is the market telling you what it believes about the future, and it believes the future is more expensive. Grocery chains begin quiet conversations with suppliers. Fuel distributors start recalculating contract terms. These are not decisions made in boardrooms with headlines. These are phone calls, spreadsheets, risk managers running scenarios. The price of wheat futures rises 8% in 2 days. Crude oil climbs 11%. Copper, lumber, soybeans. The entire commodity complex begins moving as if anticipating something the public hasn't yet noticed, because the public is still watching stock prices. Day 6 is a Saturday. Markets are closed, but the economy is not. In living rooms and kitchen tables across the country, people begin making small decisions that collectively become enormous. A family sees news about currency instability, about inflation risks, and decides to stock up on groceries. Not hoarding. Just an extra week's worth. Rational precaution. 10 million families make the same rational decision in the same 72-hour window. Grocery stores in suburban Texas, Ohio, North Carolina report inventory moving faster than usual. Not panic buying. Not yet. Just velocity. Managers increase orders. Distributors notice the uptick. Warehouses respond. But warehouses operate on just-in-time inventory models optimized for predictable demand. A synchronized increase in demand, even a modest one, creates lag. By Monday morning, day 8, certain products are simply harder to find. Not absent, harder. The pasta aisle looks thin. Canned goods have gaps. Meat sections are restocked slower than they're emptied. This is not collapse. This is friction. But friction, when multiplied across a continent, starts to feel like something else. That same morning, the Federal Reserve announces additional measures. Swap lines with foreign central banks are expanded. Emergency lending facilities are activated. The language is technical, calm, procedural, but the frequency of announcements is increasing. And increasing frequency signals uncertainty. On day 9, the first bank admits a problem. Not a major institution, a regional bank. Mid-sized, the kind that handles mortgages and small business loans in second-tier cities. It releases a statement explaining the temporary limits on large withdrawals. The phrase used is, to ensure liquidity for all customers. The limit is $10,000 per day. For most people, this is irrelevant. For businesses trying to make payroll, it's a crisis. The bank's stock falls 19% before trading is halted. 3 other regional banks with similar exposures see their stocks fall in sympathy. Not because they've announced anything, because the market assumes contagion. Here's what's happening beneath the surface. Banks operate on fractional reserves. They hold a small percentage of deposits as actual cash and lend out the rest. This works because in normal conditions, withdrawals are predictable and spread out over time. But when 10 trillion new dollars flood the system, when inflation expectations spike, when people begin doubting the stability of their deposits, the psychology shifts. It only takes a small percentage of depositors deciding to withdraw funds simultaneously to create a liquidity crisis. The bank has the assets. It has loans, securities, holdings, but it doesn't have cash. Not enough, not immediately. And in a bank run, immediately is all that matters. By day 10, the FDIC issues a statement reassuring the public that deposits are insured. This has the opposite effect. People who weren't worried begin to worry. The statement makes the evening news. A financial commentator explains very calmly that the FDIC insurance fund contains roughly $120 billion to cover trillions in insured deposits. The commentator clarifies that the fund has never needed to cover total deposits, only a small fraction in any crisis. This is accurate. This is also terrifying when said out loud. On day 11, the lines start. Not everywhere, not at every bank. But in cities where regional banks have concentrated presence, people begin arriving early. Some branches open to 50 people waiting outside. The withdrawals are orderly. Tellers are polite. Customers withdraw their maximum politely and leave, but they leave and tell their neighbors. By afternoon, the lines are longer. Social media amplifies this in real time. Videos of lines outside banks circulate on platforms with captions like, "Is this happening where you are?" and "Just withdrew everything. Better safe than sorry." These posts are not misinformation, they are documentation. But documentation, when viral, becomes catalyst. That night, the president addresses the nation. The message is calm. Confidence in the banking system, confidence in the Federal Reserve, confidence in the strength of the American economy. The speech is 8 minutes long. The stock market futures, trading overnight, fall 4% during the broadcast. Day 12 is when payment systems begin showing strain. Credit card transactions start declining at unusual rates. Not because accounts are empty, because payment processors, seeing volatility and uncertainty, tighten risk algorithms. A transaction that would have cleared yesterday gets flagged today. Merchants in certain industries, certain geographies, find their batch settlements delayed. Money is moving slower through the network. Payroll companies that rely on ACH transfers for direct deposit begin experiencing delays. Employees expect paychecks Friday morning. They arrive Friday afternoon or Saturday. For workers living paycheck to paycheck, a 2-day delay is a crisis. Rent is due. Groceries are needed. A 2-day delay means overdrafts, late fees, missed payments. The Federal Reserve, by now, is in continuous session. Emergency meetings that were daily are now twice daily. Statements are released every few hours. Each one sounds confident. Each one arrives faster than the last. Confidence is inversely correlated with frequency. On day 13, the US dollar falls below a psychological threshold against the euro. The exact number is irrelevant. What matters is the headline. Dollar plunges to historic low. The word historic does work in the human brain. It separates today from yesterday. It makes the present feel unprecedented. Even if the decline is only 15% from peak, even if currencies fluctuate, the narrative has shifted. Foreign holders of U.S. debt begin quiet divestment, not dumping. Central banks don't panic, but they rotate. They reduce exposure. They diversify into assets that aren't denominated in a currency being actively diluted. Chinese, Japanese, and European central banks don't announce these moves. They don't need to. Treasury auctions begin showing weaker demand. The U.S. government, to sell its debt, must offer higher yields. This raises the cost of financing the federal deficit, which is expanding. Because $10 trillion in monetary expansion often accompanies fiscal expansion. The feedback loop tightens. Day 14 is when fuel prices become a national conversation. Gasoline, diesel, jet fuel. All priced in dollars, all rising as the dollar weakens. A gallon of regular gasoline that cost $3.40 2 weeks ago now costs $4.70. This is a 40% increase in 14 days. Commuters notice, truckers notice, airlines notice, delivery companies notice. Shipping costs spike. Companies that operate on thin margins, retailers, restaurants, start making cuts. Hours are reduced. Orders are smaller. The velocity of goods slows even as the velocity of money increases. Stagflation is not a theory, it's a condition. Statement blames supply chain costs, fuel expenses, currency volatility. Competitors follow within hours, because if one chain raises prices and another doesn't, the one that doesn't runs out of stock. Game theory in real time. Shoppers notice immediately. A cart of groceries that cost $120 last month costs $170 this week. Families adjust. They buy less, they buy cheaper, they stop buying certain things entirely. Demand shifts, suppliers respond. The entire consumption chain recalibrates to a poorer population. By day 16, civil unrest begins in isolated pockets. Not widespread, not coordinated, but visible. A protest outside a bank that limited withdrawals, a clash at a grocery store where shelves are empty. These incidents are local, but they're filmed, they're shared. They create a sense that order is negotiable. Local governments respond with curfews in some areas. Police presence increases near banks and grocery stores. The imagery is subtle but unmistakable. The machinery of the state is now visible in daily life. Not oppressive, just present. A reminder. On day 17, the Fed pivots, an emergency announcement. Interest rates are raised not by a quarter point, by 2 full percentage points. The largest single increase in decades. Now, the statement says this is to defend the dollar, to anchor inflation expectations, to restore confidence. What it actually does is create a new crisis. Raising rates makes borrowing more expensive. Companies with variable rate debt see their interest payments spike. Homeowners with adjustable rate mortgages see monthly payments jump. The stock market, which had been volatile but resilient, collapses. The S&P 500 falls 9% in a single session. Retirement accounts evaporate. Wealth, on paper, vanishes. The Fed is now trapped between two forces. Print money, the dollar dies. Raise rates, the economy chokes. There's no clean path, only choices between bad outcomes. Day 18 is when the realization spreads. Not among economists, not among analysts, among normal people. The understanding that something fundamental has changed, that the assumptions underlying daily life, the stability of money, the availability of goods, the function of institutions, are not permanent. They are conditional, and the conditions have shifted. Bank runs intensify, not just at regional banks now. Major institutions see withdrawal surges. Lines form in Manhattan, Los Angeles, Chicago. The FDIC, the Fed, the Treasury all release coordinated statements. But statements are just words, and words without trust are noise. On day 19, the payment grid shows its first serious failure. A major payment processor goes offline for 4 hours. Not hacked, not attacked, overloaded. The volume of transactions, the verification requests, the liquidity checks exceed system capacity. When it comes back online, there's a backlog. Transactions that should settle instantly take hours. Some don't settle at all. Errors compound. Restaurants stop accepting credit cards, cash only. But ATMs are rationing withdrawals. Some have run dry. The circulatory system of commerce is clotting. By day 20, international responses begin. The European Union announces a temporary currency stabilization fund. China accelerates its de-dollarization initiatives. OPEC nations quietly begin discussing oil contracts denominated in alternative currencies. These are not punishments, these are adaptations. The global system is reorganizing around a diminished dollar. For Americans, this means imports become crushingly expensive. Electronics, vehicles, pharmaceuticals, anything produced abroad and purchased in dollars, reprices upward. The standard of living for a population accustomed to cheap global goods contracts. On day 21, the president declares a national economic emergency. The declaration allows for temporary capital controls, price freezes, rationing measures. The language is careful. Temporary, emergency, necessary, but the precedent is set. The government has asserted control over economic activity in ways that were theoretical 3 weeks ago. Some people comply, some resist, some simply stop participating. Barter networks emerge in communities. Informal economies expand. Trust in dollars is replaced by trust in tangible goods, in relationships, in things that hold value outside official systems. The cities fare worse than rural areas. Density requires complex supply chains. When those chains break, density becomes vulnerability. Urban populations, dependent on daily deliveries of food and fuel, experience shortages first and hardest. Grocery stores in metropolitan areas see empty shelves, not because trucks stopped running, but because just-in-time inventory can't absorb even modest disruption. Rural communities, with more direct access to production, with less dependence on financial infrastructure, adapt more quietly. They were always closer to self-sufficiency. Now that proximity is an advantage. Throughout all of this, a small segment prospers. those who held assets outside the dollar, those who owned land, commodities, foreign currency, gold, those who understood that wealth is not money, but what money can be exchanged for. And when money loses credibility, the things it once bought become the new wealth. This is not a story of villains. There are no conspiracies here. Only systems pushed past their tolerances. Only humans responding to incentives. Only the mathematics of currency, debt, and trust playing out at scale. The Fed's $10 trillion didn't disappear. It's still in the system. But it changed the system. It altered the relationship between effort and reward, between saving and purchasing, between present and future. And here's the haunting part. None of this required malice. It required only a decision made in a marble building by intelligent people with good intentions, a decision to solve one crisis by creating the conditions for another, a decision that seemed, in the moment, like the only option. 3 weeks ago, the dollar was just money, something you didn't think about, something that worked. Now it's a question, and questions, once asked, are hard to unask. The simulation doesn't end on day 21, it continues. Because economic collapse is not an event, it's a process, a slow unraveling of systems built over generations. And the timeline, once started, follows its own logic. If you're still watching, you understand something most people don't. That the distance between normal and chaos is shorter than it appears. That the mechanisms are already in place. That all it takes is a catalyst large enough, fast enough, to outpace the system's ability to absorb. There are more simulations, more timelines, more scenarios where the assumptions shift and the outcomes cascade. If this one left you unsettled, the next one will leave you prepared.